Yesterday I showed this trade on the live stream. You can go back on my stream from yesterday. This was actually my entry. At that time of the stream, it was at 9 in the morning. We were here, okay? So during the day when here at 2 o'clock New York opened and it made this choppy move, so the majority of people placed themselves in the beginning of a session, or just before or just after. But I realized that in these cases it's very hard to stay in a trade, okay? It's very, very, very hard. The only trade you could have made here is this imbalance, and the problem with this imbalance is that we didn't have our break of structure yet, so it could have done just this, okay? And otherwise, on a long-term basis, you will not win. You will have 1, 2, 3, 5 lucky shots, but you will not win in the long run, okay? So right now, this hit my TP2 this morning. The major move of the day was to liquidate these positions and these positions and these positions, okay? So all these people going short in that areas because we were in a downtrend, the most liquidity was on these wicks, okay? So I told myself, where was yesterday the most traded volume? Yesterday the most traded volume was in this area here, okay? And this is also named an order block. So we had an order block, we had all the imbalances closed because the day before I already traded the Euro USD here, and we hit the targets and we made over 2k on this move, okay? So the day after, at the beginning, when it was here, I thought I'm gonna enter here, but the problem was that we didn't saw the break. So I was like, no, we have a break of structure to the downside. But then I saw this move coming, and I was like, okay, we are creating some type of falling wedge, which is a bullish pattern, and I wanted to be cautious trading these levels here and going short like they did here, okay? The majority of people went short on these candles, and we waited because of the open, there is a lot of liquidity. Look, it was the biggest volume candle of the day. So this is when the big banks, the central banks, they have a timeline of when they need to provide liquidity to the markets, and it's really a time-based investment or liquidity providing, not an opportunity-based liquidity providing. So the markets and the banks, they need to do it, okay? They need to inject that liquidity. To inject that liquidity, they need sellers. So what happened? They bought liquidity to the downside, everyone's going short, okay? Then they took that liquidity to position themselves. They pushed back higher the market. They saw new shorts are entering, and here you see these two volume candles, all the retail went short, 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 and this is where they put the next buy in, so that the price stays, let's say, stable when they go into the market. And already here they were done with their day, okay? So for me, this was the next interesting point. So why did I put the stop here at the beginning? It was just over here because of this wick here. There was a big chance we can fill, not everything, but at least fill until here or until here, okay? So this is why I put a big stop. Otherwise the trade would have already hit the target, okay? Sometimes this is what you need to do to stay on the safe side, okay?